Everyone's panicking about the market crash, worried about what the Fed will say next. But while most are selling, are you watching what the big money is doing? BlackRock is on a mission, snapping up millions of Ethereum like it's a foundational piece of the future internet. At the same time, traders are making huge bets on one last massive surge for Bitcoin before a major cooldown. With some analysts pointing to a significant market peak this October, the big question is this a time to panic, or is this the last chance to get in before the next big move? In the latest video from Altcoin Daily, the discussion kicks off with a look at how global retirement funds could affect Bitcoin's price. There's a massive $60 trillion sitting in these funds, and investment expert Bill Miller suggests that if just 1% of that money moved into Bitcoin, it could add $30,000 to its price. A 2% allocation could even push Bitcoin to $175,000. To counter the idea that this is just wishful thinking, the video points to Harvard's endowment fund, which recently invested $116 million after one of its own economists had previously been very down on Bitcoin. The host then explains that a $600 billion inflow, 1% of $60 trillion, wouldn't just raise the market cap by that amount. Since there are fewer than 2 million Bitcoin available on exchanges, that much buying pressure would send the price soaring due to the limited supply. The idea of retirement funds moving into Bitcoin is really powerful and has been a narrative for years. The video does a good job of breaking down the simple but dramatic math. My view is that while the potential is undeniable, the actual execution is far more complicated. Pension fund managers are famously risk-averse, and Bitcoin's volatility is still a massive hurdle for them. We're seeing some progress with companies like Fidelity allowing Bitcoin in 401k plans, but that's a choice for individuals, not a large-scale allocation by the fund itself. The market structure bill mentioned by Senator Lummis seems to be the real key here. Without clear regulatory guidelines, most of these multi-trillion-dollar funds won't even consider an allocation. So, while the what-if scenario is exciting, the legislative groundwork has to be laid first before we see that floodgate of retirement money truly open. In the latest video from the Crypto Rover channel, the host lays out his plan for a massive Bitcoin trade, betting over $10 million on his next move. He believes that based on the M2 global money supply, Bitcoin is gearing up for one last major push upwards before entering a significant downtrend. Currently, he sees Bitcoin in a short-term downward pattern and expects it to drop further. It's always interesting to see a trader lay out such a high-conviction thesis with a specific dollar amount attached. Placing a $10 million bet between $109,000 and $111,500 shows an incredible amount of confidence in that specific support zone. The market has been choppy recently, with a lot of uncertainty tied to inflation data and what the Federal Reserve might do next. His idea that the market will dip to grab liquidity before a final surge is a classic trading pattern many look for. The 6-week timeline for a market top is a particularly bold call. While many analysts agree this cycle isn't over, putting such a precise expiration date on it adds a lot of pressure. It feels like a make-or-break moment for this kind of short-term prediction. In the latest video from the Crypto Tips channel, the host connects some worrying economic signs to the future of crypto. He points to a report in the Straits Times showing Singapore's exports to the U.S. have plunged and notes that shipping traffic from China to the U.S. is at a 2-year low. He argues this is because the U.S. is engaging in debt monetization, essentially printing money to buy its own debt because no one else wants it. This, he says, is incredibly inflationary and a huge reason why the American middle class needs inflation hedges like Bitcoin. The video does a good job of tying large-scale economic trends to the crypto market, which is a narrative that's becoming more and more relevant. The point about debt monetization in the U.S. isn't just talk. The national debt is climbing at an alarming rate, and it does make the argument for a finite asset like Bitcoin pretty compelling. As for the Ethereum short squeeze, it's a classic market scenario. While the conditions are there for an explosive move up if prices start to rise, it's also a high-risk situation that depends on a bullish catalyst to actually force shorts to close their positions. The discussion on DeFi regulation is particularly timely. The industry is definitely at a crossroads where projects will have to decide between compliance and the core principles of decentralization, And we're already seeing this play out with government actions against platforms like Tornado Cash. In the latest video from Lark Davis, he lays out a theory that the crypto market might hit a significant local peak this October. Instead of just guesswork, this prediction pulls together several data points. It starts with price targets from analyst Chris Berniski, who used Fibonacci extensions to call for Bitcoin at $142,690, Ethereum between $6,900 and $8,000, and Solana around $420. These numbers aren't random. They align with key Fibonacci levels that have historically acted as magnets for price action. The idea of a macro-driven peak is pretty compelling because it connects crypto to the wider financial world, which is becoming more and more relevant. The M2 supply theory has been a solid indicator in the past, so it's hard to ignore. However, pinning it all on a specific month like October feels a bit too perfect. The market has a way of surprising everyone. Right now, there's still a lot of uncertainty, and a September rate cut isn't a guaranteed slam dunk for a massive rally. While the logic is sound, it's also worth noting that institutional products like the ETH ETFs are just getting started. Their long-term impact could smooth out these sharp peaks and valleys, possibly extending the rally or softening the predicted cooldown period. It feels more like a strong what-if scenario than a certainty. In the latest video from the Ben Cowan channel, he takes a look at the Ethereum versus Bitcoin valuation. He's working with the idea that ETH has likely hit its bottom against Bitcoin for this market cycle. This is based on past events where major lows for the ETH-Bitcoin pair happened when Ethereum's USD price touched its lower logarithmic regression band. It's interesting to see this breakdown of the ETH-Bitcoin chart based purely on historical cycles and technical patterns. Cowan's theory about a local top coming in September makes a lot of sense, especially when tied to the historical behavior of Bitcoin dominance. However, the one major variable that could disrupt these patterns is the recent launch of spot Ethereum ETFs. This introduces a completely new source of demand from institutional players that wasn't a factor in previous cycles. While the chart shows a pattern of lower highs for ETH against Bitcoin, the unprecedented access provided by ETFs could give ETH the extra power it needs to challenge or even break that trend. This cycle feels like a major test between established technical patterns and a fundamental shift in market accessibility. In the latest video from Coin Bureau, Nick tackles the big question on every crypto investor's mind. Are my altcoins dead? He starts by explaining that crypto's 4-year cycle is still very much in play. While it feels different this time because investors bought altcoins early in 2024 and then sold them off, Bitcoin is right where it should be. This suggests Bitcoin's peak is still ahead of us, which means the real altcoin season is probably still to come, likely within the next year. The video makes a solid case by framing the current altcoin slump within historical cycles, which can be reassuring. The comparison to 2017's explosive but short season feels particularly relevant. Attention spans are shorter than ever, and capital seems to move much faster. However, the market feels a bit different today. We're seeing intense, isolated speculation in narratives like celebrity meme coins, while established projects with solid tech struggle to get attention. This suggests that when the money does flow into alts, it might not be the widespread everything pumps tide we saw in 2017. It could be far more targeted, focusing on a few hot sectors at a time. The video's point about watching the others chart is a classic, but what breaks out might be a smaller basket of coins than many are hoping for. In the latest video from Crypto's Russ, the host breaks down why it was such a brutal day for the markets. Pretty much everything took a nosedive. Tech stocks, crypto stocks, Bitcoin, and Ethereum all sold off hard. The main reason for this widespread panic is the anticipation of Fed Chair Jerome Powell's upcoming speech at Jackson Hole this Friday. This will be his last speech there before his term ends in May, and investors are worried he'll sound hawkish because of a recent inflation report, PPI, that came in higher than expected. A hawkish tone could mean no interest rate cuts, which would send markets tumbling even further. Bitcoin is currently struggling to stay above $113,000, with liquidation levels looming at $112,700 and $112,400. Ethereum is back in the $4,000 range, hitting a CME gap at $4,100 that was mentioned by Tom Lee. Other altcoins like Solana and Avalanche are down anywhere from 5% to 8%. The host believes this is a total panic day, with liquidations likely topping $1 billion again. He doesn't think altcoin season is over, though, because Bitcoin's dominance didn't shoot up. This shows that everything's sold off together. The big question is when things will recover. While more volatility is expected before Friday, there's a chance Powell could surprise everyone with a dovish message, which would cause the market to bounce back very quickly. The video does a great job of capturing the tension that always builds before a big Fed announcement. This kind of market-wide risk-off move where everything goes down together is textbook behavior when uncertainty is high. The fear about Powell's tone seems justified, as the Fed has been walking a tightrope with inflation for a while now. What's interesting is how markets tend to price in the worst-case scenario ahead of time. This can create a situation where anything less than a very negative outlook from Powell could trigger a sharp relief rally. The fact that Bitcoin's dominance isn't spiking is a key observation. It suggests investors aren't fleeing altcoins for the relative safety of Bitcoin, but are simply pulling money out of the entire crypto space for a moment. It feels like the market is holding its breath, and Friday's speech will decide if it exhales with relief or gasps in panic. In the latest video from Crypto Wendy, she brings on Sal from Ethereum to talk about their brand new XRP financial product. Sal explains that his company was the first to launch a 2x leveraged XRP futures ETF called the Ethereum Double XRP Fund. He's quick to point out that this isn't a spot ETF that holds actual XRP. Instead, it uses futures and derivatives to give traders double the exposure to XRP's daily price movements. It's pretty interesting that a firm went straight for a leveraged futures product for XRP, sidestepping the massive race for a spot ETF that everyone is anticipating. This move shows there's a clear appetite among sophisticated traders who want more advanced ways to trade XRP. While the crypto world watches the final stages of the Ripple versus SEC lawsuit and speculates if major players like BlackRock will file for a spot XRP ETF, Ethereum has already found its niche. The existence of a regulated futures ETF could actually be a good thing for the eventual approval of a spot ETF, as it demonstrates to regulators that there's a healthy and functioning derivatives market for the asset. It's a bold first step that caters to a different kind of investor entirely. In the latest video from The Modern Investor, the host points out that big companies are aggressively buying up crypto, with a special focus on Ethereum. BlackRock's Ethereum ETF, known as ETH, has already snapped up over 3 million ETH, which amounts to 2.46% of the total supply. The host thinks this is just the start, predicting that BlackRock might hold 6 to 7 million ETH by the end of the year. He notes that several companies are in a race to become the biggest corporate owner of Ether. This institutional rush is happening because it's simply cheaper and faster to acquire a large portion of Ethereum's supply compared to Bitcoin's. The points made in this video really get you thinking about the two sides of crypto adoption. On one hand, the institutional scramble for Ethereum is undeniable. It feels like we're watching the early days of a digital real estate grab where major financial players are buying up the foundational layers of the next internet. BlackRock's move isn't just about offering a new product, it's about owning a significant piece of the infrastructure. It signals that the financial world now sees Ethereum not just as a speculative asset, but as a critical technological platform. The real story isn't just that they're buying, but the speed at which they're doing it. In the latest video from CryptoJeb, he breaks down the two most likely paths for Bitcoin following its recent price drop. He's pretty confident that we're not heading into a bear market just yet. Instead, he sees this as a shakeout before a very profitable fourth quarter. Right now, he's closely watching a key downtrend line on the hourly chart. If Bitcoin can break above this line, maybe push towards $115,000 and then successfully retest that line of support, it could be the perfect setup for a long trade. He points to a few encouraging signs, like the RSI bottoming out and a potential bullish MACD cross on the 4-hour chart. Jeb's analysis presents a classic technical scenario, a potential breakout versus a breakdown to a stronger support level. His focus on the $100,000 to $105,000 zone as a potential floor makes a lot of sense, as that's not just a huge psychological number, but also lines up with major long-term technical indicators. The current market sentiment does feel a bit shaky, with many traders waiting for a clear signal one way or the other. While his technicals are sound, it's also worth remembering that major economic news can sometimes throw a wrench in the charts. His reminder about preparing for an eventual bear market is a sober and necessary dose of reality in a space that can often get caught up in endless upward predictions. It's a good long-term perspective to keep in mind.